Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham. This is episode 26. And boy, after a week off, Thanksgiving week, the market is not giving us any favors. We're going to discuss Jerome Powell and the Fed's decision to taper bonds. We're also going to talk about the new coronavirus COVID variant and all that entails, and really how do you start to structure your portfolio based on some of this new information. So those are the things we're going to discuss today. Please remember that this podcast is for entertainment purposes only. I am not your financial advisor. Do not buy or sell anything based solely on what you hear. Please discuss this with your advisor, and just remember that past performance is not indicative of future results. So with that out of the way, let's get to work.
You dropped this.
So thank you for joining me yet again on another podcast. I appreciate you taking the time to do this. Let's see if we can't make sense of some of the things that are happening out there. I did want to first off say most of the people who listen to this, 90%, 95% are on Spotify or Apple. And so if you rate the podcast, give me 5 stars, 4 stars, 1 star if you hate it, whatever. Tell me you love me, tell me you hate me, just tell me something. If you would rate this, it'd go a long way in helping us out. So appreciate you taking the time to do that. So over the past 2 weeks, there's been a lot of volatility when it comes to the stock market. You're seeing some of these high price stocks get corrected down. And so let's talk about that a little bit. So one of the things you have to realize is that the Federal Reserve Jerome Powell came out and said that for months he's been saying that they're not going to, that he thinks inflation is transitory and that he thinks that inflation would work itself out. And then he did kind of an about face on this right before Thanksgiving. And so it's important because he did get renominated. Looks like that'll happen. And so he'll still be the Fed chairman for the next 4 years. And so he said that he doesn't think that inflation might not be as transitory as he once thought it was, wants to retire that word. And so he said that they could accelerate their reduction, their tapering, which is that the Fed could cease to buy as many bonds per month that they're currently buying, which when they got done with that, the thought is that they would start to raise interest rates. So to think about this, why does this impact the market so much? Well, when you have interest rates that are low, it allows people to borrow a lot, right? So just think about something easy like a mortgage. If you're, taking out a mortgage at 2.5%, 3%, you can buy a lot more house than you can if the interest rates are 5%, right? So when interest rates are low, it encourages the consumer to go out and buy things, to to take on risk, to do all of those risk-taking things, or to consume more. Well, when interest rates start to go up, obviously the opposite is true. That it becomes more costly. Well, when it comes to the stocks that you potentially own, if you have companies that are supposed to be making money out in the future, right? So maybe they're not profitable today, but they're supposed to be profitable in 3 years. They're on this path to profitability. Well, if interest rates are going up, that makes those profits that they are expected to make in the future worth less today. And so you are going to see those stocks get repriced. So we have Jay Powell coming out saying we're going to taper faster probably than we said we were going to, and which would lead us to raising interest rates faster than we thought we were going to. And you start seeing the market price that in. And so you start seeing a lot of those high flyers start to get repriced. And so you add that with the new COVID, Omicron, Optimus Prime, whatever the name of it is, pick your favorite transformer. You add that with that new variant, and so now there's a lot of risk in the market. Right now we have, okay, our company's going to do lockdowns, what's going to end up happening with this. And so if you have the Fed saying that they're going to work towards raising interest rates, and then you also have the combination of a new COVID variant, it is not very good for the stock market. So the stock market typically looks about 6 months out. And so if it looks unsure, then the stock market does not like uncertainty. And so you see that volatility start to creep up. So, I named this episode Under Pressure because you really have to start paying attention to what you own and how is it going to be impacted by rising interest rates and in an environment where the Federal Reserve is not having this easy money, this easy monetary policy that we've been seeing. And that is going to be paramount to how your investments are going to perform later on, as we move this direction. And so some of the easy money, might have been made already, right? And so you have to start thinking about, what is my portfolio? What are the stocks that I have? How are they going to perform if times are tougher? So for example, if you have a stock that doesn't pay a dividend, the only way you're going to make money is if it goes up, right? That's the only way you're going to make money. Is the stock going up or is the stock going down? So you have to start looking at, do I have safe stocks? Do I have safe ETFs or safer? I mean, there's a level of risk in everything you do, but we've had 2 to 3 really good years after COVID, stock market wise. And you have to just think to yourself logically that we might have a year or two where returns are not that great, especially if interest rates are rising and, things are kind of returning to a little bit of normalcy. And when I say normalcy here, I'm talking about Federal Reserve monetary policy, where the Fed isn't supporting the economy as much, buying bonds, because that's what the tapering is. The Fed has been buying bonds every single month. They buy so many bonds every single month, so there's constantly a buyer in the market. And then as they taper is just a fancy word for we're not buying as many, right? And we want to see if the market can sustain itself on its own. And so, you can also invest in companies that are going to pay you a dividend where even if the stock isn't doing that well, you're going to make some money based on the dividend. And for a year or so, that might be as good as we're going to be able to do. I mean, we might have a year where stocks are in hibernation, if you will, because there's just not, enough out there. And so, stocks have done well for the past couple of years because when interest rates are when interest rates are low, it's hard for other investments to compete. Right? So if you're taking your investment dollars and you would normally put it into bonds or CDs or your savings account, you're currently not making any interest. You're not making any money on that, right? And we've talked about that. Unless you're a vampire, 0.01% in your savings account is not very helpful. So, but if we truly have some interest rate, if we get off zero and we kind of move up a little bit, then there will be potentially some competition for stocks, which is going to be, could take some dollars away from stocks and bring the value down. So it's something that you need to pay attention to. Now, as with most things, there of course are opinions on both sides. There are some, commentators, some investors who think that inflation is going to, be extremely high. It's going to continue. It's going to be around for a while. And then there's others who think that it will unwind quickly, that as soon as some of the ships that are in all these ports that haven't been unloaded, as soon as the supply chain, eases out a little bit, that inflation won't be as bad. There's also people who say that technology The ability for companies to invest in technology allows them to keep inflation at bay. And so there's a lot of different opinions, a lot of people, a lot of investors on both sides of the coin. And so, again, with that being said, that produces uncertainty. And anytime you have uncertainty, there is going to be more volatility in the market. So you got to be really sure about what you own and if you're willing to own it for a period of time where you might have to own it for a while because you might be under your cost basis. You might get behind on some of your positions. And so you got to be, are you going to be okay with that? If we were to go into a bear market, which a bear market is a 20% drop from recent highs. We're not close there. I mean, some sectors might be, but overall, not really. But if we had a 20% drop, that would be considered a bear market. Most bear markets last 18 months. So one of the things I always ask myself is, okay, if I have to own this, do I like this company enough? Am I willing to be an investor in this? Am I okay collecting the dividend, having the dividend buy more shares, right? Dividend reinvestment plan we talked about in one of the previous episodes. Am I okay adding to this? Is this a company that I want to be invested in for the long term because I believe in the company? So this is when you really got to decide if you're going to be an investor or are you going to be a trader? Because if you're going to be a trader, you got to make sure that you implement some things where you can get out of stuff before you really get hurt. And so this is just my cautionary tale to you. If you look at some of the stocks that have performed terribly over the past 6 months, a lot of them were the darlings of COVID, right? So you look at Peloton, let me see here. Peloton the last 6 months has gone from $125 to $43. That's pretty rough. You look at Zoom. Zoom the last 6 months has gone from $400 to $183. And so a lot of these are getting cut in half. And, if a stock drops 50%, it's got to go up 100%. So, you got to be cautious with what you have. Is it something that you really believe in, that you think that is going to happen? And those two companies, they don't pay you a dividend. So if you bought Zoom for $400 and you're holding it at $183, you either have to decide I'm going to put a little bit more money into it, or I'm willing to hold it, or I'm going to take the loss. I mean, those are not fun decisions to make. I even had one. I always try to share my good and my bad. I got hit with one this week in my portfolio, which is DocuSign, which got absolutely crushed yesterday. It dropped 42% in a day. So it started the day at $234 and ended the day at $135. And so, there's a couple things you can do. You can do stops. You can put stops in place where if a stock drops so much, it'll sell you out automatically. But here's a word of caution on that. Stops do not work in after-hours trading. So they only work when the market's open. So that is something that you have to think about. Stops do not work during after hours. And so this is one where the company came out and basically their quarter was okay, but their guidance was terrible. And they discussed how, basically that they didn't realize how much of their business was coming from, COVID lockdowns and things of that nature. They thought they'd be able to adjust better, and they're just not able to because many people are going back to their old ways of, having documents signed. Now, should they be down 42%? Probably not. I've been doing this a long time. This is the worst one-day performance for a stock I've ever had that didn't go bankrupt. And I didn't have a lot in it. It wasn't even 1% of all the money that I manage. I mean, it wasn't a big piece, but man, is it a wake-up call that you really have to look at the valuations of some of the companies that you own, even if they, are going to be companies that are going to be around. I mean, I have no thought process that DocuSign is going to be in any kind of trouble financially, but some of the valuations on some of these companies have been extended, and so you really have to be to pay attention to that. So just to give you perspective, the average volume on DocuSign, the average volume is 3.3 million shares a day. And yesterday, 76 million shares traded, which on a 40% drop, you know where they were going. They were all going out the exit, right? So that is just a brutal, brutal day. And it's probably a little bit overdone, I would think. But, valuation-wise, based on the profitability they think they're going to have in the future, with if interest rates start to go up, that comes down. And so, it makes DocuSign probably worth about $100 a share if interest rates truly do go up. So you have to be careful. And you'll notice if you look at some of the stocks this past week that did well, Apple is one of the stocks that did well. And why did Apple do well? Well, Apple has a lot of cash flow. Apple has a lot of cash on the balance sheets. Apple has a lot of options when it comes to being able to pivot and kind of change no matter what's happening in the environment around them because they are so financially sound. And so you'll see investors, you'll see this flock, they'll flee to safety is kind of what they call that, which are the, bigger blue chip type companies that are going to be able to handle higher inflation, and also companies that don't have a lot of debt. When you go back and look at our balance sheet discussion from two episodes ago, because if a company has a lot of debt, they're basically just promising, future profits to that debt. So you have to, take that into consideration when you're looking at your investments. I completely get that, this isn't the most entertaining subject to discuss. I mean, if I wanted my podcast to be very, very entertaining, I would just cover, murder mysteries, crime. I've said that before. But it is important, and this is when all the things that we have discussed, even in the first 26 episodes, this is when all that stuff starts to come around and you realize when you can use it, the dollar cost averaging. If you're, in a choppy market, don't take all your money and invest it in a stock at once. I mean, your chances of being right on that, are slim. So look at the companies that you want to own, right? Go back to I believe it was episode 1 where we talked about designing, if you had $100,000 portfolio, what's that going to look like? Look at the companies that you want to own and start following them, tracking them. And many of you that are listening to this are young, and the greatest investment you have is yourself and your future income. So even if the market drops, commit to putting more money in as it drops, doing the dollar cost average, making sure that every time you get paid, you're going to invest a little bit of that. Have some faith that, some of these things that are going to happen, that are out there that are making the market nervous are going to go away. In 6 months, we'll have a much clearer picture on what inflation really looks like. We'll have a much clearer picture on what Omicron or whatever variant we're on. I mean, I really, truly believe that just every 6 months there's going to be a new one. We'll get more clarity on that. But again, in 6 months, there's going to be another issue. In 6 months, I promise you, we're going to be already discussing the political midterm elections. That'll already be, having its way messing up the market. So there's always something, and there always has been something, and there always will be something to worry you about the market. And you just got to have a little bit of blind faith and say, okay, these are the companies I want to invest in. If they drop a little bit, I'm going to be willing to hold them. I'm going to be willing to invest more in them, and I'm committed to them. But you got to make sure that those companies that you're looking to do that with, you've done the research on, and that they are stable financially, that they can withstand some storms, and they're companies that aren't just going to be the latest fad, and that they're going to be around for a while, right? So Warren Buffett, one of his famous sayings is, if the stock market was closed and you had to invest money and you couldn't take it out for the next 20 years, 10 to 20 years, would you be okay investing in this company and just walking away for a while? Right. So when you look at what you own, think, use that as a barometer, and see if you would still own the stuff that you own today. When I'm doing it, I always think to myself when I'm looking at a portfolio, if this was all cash, right? If all my holdings were now cash, would I still want the same amount in the stocks that I in the investments that I currently have? So, this kind of takes away, if I have a huge gain in something or whatever, I don't become emotional about a stock because, oh, look, I have a big gain, so of course I'm going to keep that one. So it kind of gives me an honest way to look at it and say, okay, if this was all cash, would you still be in the same stuff that you're currently in, based on the environment that we are currently in, because the environment is becoming different than it was a year ago. So, these are just kind of little things that you can do to prevent yourself from being emotional or making a rash decision, because you don't want to do that. When people start making emotional decisions, especially when it comes to their money, they're usually not well thought out. And sometimes you just got to sit on your hands and just wait for a little bit more clarity before you start making rash decisions and costing yourself money. So my final thoughts on this is that the volatility is probably not going to dissipate in the coming weeks, and there's a couple reasons for that. Maybe it will. But one of the things you have to keep in mind is that as we get closer to the end of the year, there's a couple things that happen in the market that cause people to have to sell. So one of the things is, with IRAs and IRA accounts, older people, they have what's called a required minimum distribution, which means they have to take a distribution from their accounts as they age. And so most of the time, those are done in the month of December. Normally, they have to sell something to make that happen. You'll also have people start to tax loss harvest, where they're trying to balance out the gains they've taken for the year with some losses so they can reduce their taxable their investment taxes. And so you kind of get a lot of weird action as far as selling and stuff is concerned in the month of December. But that could add to some of this volatility that we're seeing, because you get people who want to get in front of that, or they're trying to lock in losses, or they're trying to lock in gains. And so if you have a time horizon that's a couple weeks, who knows what's going to happen. But again, you got to stretch it out, think about years, not weeks, not months, and have a longer term time horizon when it comes to your investments. So if you do those kind of things, it'll help you withstand some of the daily volatility that you see. And I want to remind you, there is an investment bias called myopic risk aversion, which basically means that the more you look at your investments, the riskier they appear. So if you're watching your investments every single day, you're seeing every tick up, every tick down, you're going to perceive those investments to be riskier just because you're seeing all the action. So, just think about that before you start, making decisions that you might regret one day. Take the long-term approach. So, which I know many of you are doing, and make sure you understand the riskiness of some of the investments that you're in. Go through your holdings, say, okay, is this one a dividend payer? Is this one not? How do I protect this position? So I appreciate your time. We of course have to go over goals in the next couple of weeks. That's something that you need to start working on during the month of December. It's kind of a fun thing. Start planning out your 2022. And we'll get working on that as soon as possible. So anyways, I wanted to go over volatility today because I knew it was going to be important to many of y'all listening to this, and kind of some of the things that are causing it. So with that being said, I hope you have a wonderful, productive week, and I will see you soon. Thanks, everybody.